This is your LMAX Exchange technical update for Tuesday, March 28th, 2017. Euro dollar. So the euro is now broken up above some critical resistance at 108.75 to trigger the formation of an inverse head and shoulders on the daily chart, which could project gains all the way up towards 114.10. That would be the pattern objective after the market had consolidated between that 108.75 neckline and the head down around 103.40, that 2017 low. At this point, though, we would need to see still some confirmation with the market establishing above 108.75 to convince of this bullish formation and open the door for that move towards 114.10. Inability to establish above 108.75 would still keep the pressure on the downside and potentially suggest a resumption of declines and a resumption of the broader downtrend for a retest back towards the 2017 low down at 103.40. And so we would recommend looking at 109.50 as that key level to see if the market can close above or below over the coming sessions. If the market closes above, then we could really see that acceleration towards 114.10, but if the market can't establish above 109.50 on a daily close basis, there is risk for a topside failure and a negation of this inverse head and shoulders formation and a bearish resumption. Overall, on a short-term basis, though, we would need to see a break back below recent support, which comes in around 107.61, to take the immediate pressure off the top side. Sterling dollar. So cable has seen a nice run up over the past several days, with the market trading above 125 and above 126 into a very important resistance zone. Overall, the pressure here remains on the downside while the market holds below the December 2016 peak at 127.75, and so rallies should continue to be very well capped ahead of the next major downside extension back down towards the recent 2017 low at 1987, which guards against the more critical plus 30-year low from October of 2016 at 118.40. Only back above 127.75 would negate the bearish outlook for sterling dollar. Dollar yen. So dollar yen has seen a breakdown below some key range support at 111.60, and this has opened the door for a fresh measured move downside extension up to 107.60 over the coming days. At this point, it would take a break back above some recent resistance around 111.80 to take the immediate pressure off the downside. Euro Swiss. So Euro Swiss has been a slow go to the downside over the past several months, although overall the pressure does remain on the downside, with the market being very well capped into rallies and looking to put in another lower top now at 108.26 ahead of that next major downside extension. Of course, we will need to see a break below 106.24, the 2016 low, to confirm, but a break below that level would open a measured move downside towards the 104 area over the coming days and weeks. At this point, only back above 108.26 would delay the bearish outlook for Euro Swiss. Aussie dollar. So Aussie has shown signs of topping out yet again as it rallied up above 77 and towards 78. The market has been very well capped into towards 78 over the past several months, and so this latest topside failure is adhering to this trend of stalling out towards 78, and we should see additional setbacks over the coming sessions, initially back towards recent support, which comes in at 74.92, a break below which would expose a drop down towards the 70 barrier. Again, only back above recent highs that we saw at 77.50 would really compromise the bearish outlook for Aussie dollar. Dollar CAD. Dollar CAD continues to be very well supported on dips, and overall this is a market that is favoring the upside, and so this latest setback towards 32.64 is expected to be well supported ahead of the next major upside extension beyond recent highs that come in around 135.35 and towards that multi-day peak at 136 further up. A break above 136 would then open the next major upside extension towards 140. Only setbacks now below 132 would delay the current constructive outlook. Kiwi dollar. So Kiwi has been consolidating over the past several sessions, but overall here the structure looks quite toppish as the market has stalled out yet again ahead of 75, this time in 2017 ahead of 74, and it looks like the market should be putting in a lower top over the coming sessions in favor of that next major downside extension back towards and below the recent support, that medium-term support from December of 2016 at 68.62, below which would expose the 65 area. SPX 500. So the S&P 500 has broken down over the past week, but the market has been very well supported on dips and is now consolidating just under the previous support now turn resistance in the 2350 area. Ideally, the market should be well capped below 2350 on a close basis, opening the door for that next downside extension below the recent lows that we saw from Monday around 2320 2321, 2322, and towards 2300 further down. Only a close back above 2350 could give reason for concern and potentially put the pressure back on the top side. But again, this is a market that has been showing the onset of a correction, which is likely to extend down towards the 2300 area initially before it even considers the possibility for a meaningful bullish resumption. Gold. So gold retains its highly constructive outlook since basing out in 2016, with the market putting in a series of higher lows and higher highs. And so this latest pullback, the most recent pullback that we saw just under 1200, has once again been supported, and this favors the formation of a higher low here at around 1195 to be confirmed on a break above 1265. That recent high that we saw going back to the 27th of February, that break would open the door for a fresh upside extension towards the 1335 area further up. So again, only back below the 1180 area would ultimately delay the bullish outlook for gold and force a shift in the structure. Until then, look for setbacks to be very well supported towards 1200 in favor of continued upside beyond 1300, and eventually back towards a retest and break of the 2016 high at 1375.